This is Alan Bush with the daily financial forecast for Thursday, December 15th. Stock index futures coming under some pressure yesterday after the Fed announced that, in their opinion, that they could be raising interest rates 3 more times next year, 3 more times in 2018, and another 3 times in 2019. The fact that the Fed raised rates by 25 basis points was not a surprise, but the outlook for additional rate increases appeared to be somewhat of a surprise to traders. However, today we are seeing prices higher. One of the reasons for the strength today is the National Association of Home Builders Index coming in at 70, much better than a guess of 63. In fact, other economic reports on balance coming in stronger than expected. Also, I would not get in a panic mode by any means with the Fed talking about all of these additional rate increases over the next 3 years. Our work suggests that there is only 1 to 2 rate increases next year, not the 3 that the Fed is talking about. And even if there were 3 rate increases, that would not take rates high enough to actually reverse this bull market. So look for continued strength long-term in the indices, and this is a trend that I think will continue well into next year. Now, moving over to the currencies, seeing the dollar index advancing to a 14-year high. This, of course, with the Fed raising rates, causing interest rate differentials to turn even more favorable to the U.S. dollar. By the same token, the euro currency now falling to its lowest levels since 2003 for the same reason. Also, we are seeing the pound also lower in regard to the Fed rate increase. However, it does look like the Bank of England is on track possibly to raise interest rates in 2018. So it looks like the downside may be only limited for the pound, with the Bank of England likely to become a bit more hawkish down the road. Also seeing the Canadian dollar and the Australian dollar under some pressure with crude oil prices weaker. So I have to focus on the dollar index. The trend is still higher. Interest rate differentials will remain favorable, and I would expect additional strength for the balance of this year and into the first half of next year for the dollar index. Interest rate markets under some pressure, with the 30-year bonds falling to a new 17-month low. This, of course, in response to the rate increase expectations from the Fed. Our feeling is that there will be continued weakness across the board in all of the interest rate futures markets. Most of the pressure, though, likely to remain at the long end, the 30-year bonds. So any strength that we see in the bonds, for whatever reason, should be used as a selling opportunity. And this is a trend that I think will last for quite some time, and that is to the downside for all of the interest rate futures markets. So good trading, everyone. Once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.